between 2020 and 2021, we printed the most amount of money ever. We have a bubble economy right now. This is a fact. That, you know what? We want a safer investment. We don't want the dollar.
Do you think we're actually in a recession right now?
Short answer, yes. Long answer, it depends. So traditionally, the definition of a recession has been 2 quarters, aka 6 months of a economic decline. We already have that. After we saw these 6 months of economic decline, that was when we saw agencies, including the Federal Reserve Bank, the government, and a couple other agencies say that that traditional definition of a recession no longer counts. We want to look at a broad-based economic decline for whatever that means. Now, you have to think about this really just on terms of a practical level. Between 2020 and 2021, we printed the most amount of money ever. There's no way for us to actually even know how much money was printed because the Federal Reserve Bank did some funny things such as changing the definition of money. M1 is what they call it, which makes it hard for us to decide or determine how much money was actually created and injected. But we know at the very low end, between government spending and the Federal Reserve Bank quantitative easing, on the very low end, like the very, very low end, that we had printed somewhere around $6 trillion that we did not have, and we used that money to stimulate and grow the economy. So what did that do? Well, it created a bubble naturally. When you print all this money and you inject it into the economy, you are going to produce a bubble, right? It's like building a balloon and just putting a whole bunch of hot air into it. In this case, it's dollars. Now, that was good in the short term because it made people feel wealthy. Everybody got jobs, businesses boomed, investments boomed. Like everybody was making money. Home prices went up, stock prices went up. It was good in the short term. Now what we're doing is, well, we're trying to retroactively fix that because the consequence of all this money printing is inflation. You look around you, everything is so much more expensive today than it was 2 years ago. Rent prices are more expensive. Buying a home is more expensive. Buying a car is more expensive. Groceries are more expensive. Gas is more expensive. Airfare is more expensive. Vacations are more expensive. Everything is more expensive today than just a couple of years ago. So now, in order to fight this inflation, the Federal Reserve Bank is having to literally pop the balloon. And so the bigger the balloon, the bigger the bubble, the harder the crash. And this is where now the Federal Reserve Bank is saying that they want to do something called a, quote, soft landing, where they're hoping that they can raise interest rates slow enough where it is not going to contribute to more inflation, and it's going to bring inflation down slow enough that it's not going to contribute to a massive recession. Now, are they going to be successful? Only time will tell. But the reality, I mean, if you just look at this from a practical level, when you print that much money and now you got to essentially burst the bubble, it is going to hurt the economy. It is going to push the economy into a recession. And one of the things that the Federal Reserve Bank says that they want to do is they want to see asset prices fall. They want to see stock prices fall. They want to see real estate prices fall. They want to see some businesses go under. They want to see unemployment rise. They want to see more people lose their jobs. And they want to see some wages go down. Now you're going to hear me saying, Jaspreet, what the heck are you talking about? Why would anybody want that? Well, this is what the Federal Reserve Bank is saying, because inflation needs to come down, right? I think we can all agree to that. The Federal Reserve Bank says that they want inflation to come down. They want inflation to come down to 2%. Well, how do you do that? You need the price of things to stop going up or go down. And so one of the things that they say is they want to cool the housing market. So what does that mean? Well, the housing market makes up a chunk of the CPI, inflation report. And so if the Federal Reserve Bank can get the housing market to go down, well, then that will cause inflation to decrease. Because if home prices go down, then that chunk of the CPI number would go down. So that's one of the things that would benefit inflation, because that is the current goal of the Federal Reserve Bank. Same with stock prices. When stock prices are so high, it gives the Fed more ammunition to continue raising interest rates, meaning fighting inflation, because when stock prices are high, More people are spending, which contributes to more inflation. Why are people spending when stock prices are high? Because when stock prices are high, people naturally feel wealthier. And there's data that shows this, that when people feel wealthier, they go out and spend more because they feel like they can afford more stuff. Even if they don't have the cash in the bank, they feel like they can spend more because they look at their portfolio and they see all that green and they're like, well, let me go spend. Then what about jobs? Because this one gets very tricky and very interesting because the Fed has to word this in a way that's not going to incite anger, but in a way that is a little bit confusing sometimes. Because, again, what is the Federal Reserve Bank's goal right now? They want to bring inflation down to 2%. This is what they're saying today. This can always change, but as of today, their goal is to bring inflation down to 2% as fast as possible. And inflation is 8.5%, something around there, which is lower than where we were a month ago, but relative to the grand scheme of things, it is extremely high inflation, near record high inflation. And so what do they want to do in order to bring inflation down? Well, one of the things that they keep saying is they want to cool the labor market. We keep hearing about how so many people have jobs, how wages keep going up. If they say they want to cool the strong labor market, what does that mean? Well, that means that they want some businesses to go under and they want people to get laid off. Because if everybody has a job and everybody keeps getting raises, their worry is something called the wage price spiral. The last time we saw this wage price spiral was back in 1970s, maybe early 1980s. It was that time when we were facing stagflation. And what was happening was the cost of living was going up because prior to then, we saw a massive amount of money printing, and that contributed to extremely high inflation. And that inflation then caused the price of things to go up. Now, workers are saying, oh my gosh, I can't afford my rent, I can't afford my groceries, I can't afford my double guac. I don't know if they had double guac back then, but they can't afford things. And so they would go to their boss and they would say, hey boss, we need more money. And then the boss might say, okay, or they might say, sorry, I can't afford it, you're gone. But if they said, okay, then they would give them this increase in wage, but then that increased the costs for businesses. So now business costs go up, and in order to manage these higher costs, they need a higher revenue. Well, how do you get a higher revenue? Either you can sell more stuff or sell your stuff at a higher price. And that's what happened. So now businesses' costs went up, and then they started raising their prices. Now the price of everything goes up even higher. Grocery prices go higher, all your stuff goes higher, and now employees say, hey, boss, we need another raise.
More money.
And this created something called the wage price spiral, which then caused a lot of issues. And this is what the Federal Reserve Bank is trying to avoid. We're not there, but they don't want us to get there, which is why they're saying that they want to increase interest rates, to increase unemployment, to cause some businesses to go down, to cause wages to go down, because they want to cool the labor market, because that is one of their ways to fight inflation. Remember, you got to understand the goal. We have a bubble economy right now. This is a fact. This is not one of those things where it's like, oh, maybe no. It's a fact that we have produced a bubble economy because of 2020 and 2021. What do I mean by bubble economy? Bubble economy meaning something that is supported through the help of a lot of free and cheap money. We saw a number of businesses boom, grow through the help of the bubble economy of 2020 and 2021, because we saw the lowest interest rates in the history of the American economy, and we saw more money printed and injected into people and businesses than ever before during those 2 years. And so naturally, when you throw that much money around, you're going to create a boom. Like if I gave a random person on the street $10 million and I said, go start a business, well, you're going to start a business. You're going to start hiring people. You can, grow something. You might not have a sustainable business, but as long as you have money coming in, well, you can keep growing things. But as soon as I say, all right, no more money for you, now you're going to have to turn things around. And you're going to have to turn a profit. And if you don't know how, well, then it's going to cause you to struggle, and that could contribute to now you laying your people off. You might have to go bankrupt. The biggest example of this is the tech sector, the tech space, because the speculative space saw the biggest boom. And this is pretty natural. Anytime you see more of a money printing, you see more of lower interest rates, more cheaper money. People put their money into speculative assets because they're looking for more of risk. And where can you find more risk with speculative assets? And so a lot of tech companies, which were not profitable, had innovative ideas, shooting for the moon type of companies. They saw massive valuations because now all these venture capital firms and hedge funds were getting access to more money than ever before. Hundreds of millions, if not billions of dollars, thanks to the help of extremely low interest rates and money from the government, which was printed. And so now when you have all this money and you're looking for the big returns because you're getting this money essentially for free, you want to get the biggest returns. That's what they were doing. A lot of money flew into speculative assets. And over the last 6 months or so, especially over the last 3 months, when interest rates have been going up, that cheap money has been going away. And so now these hedge funds and venture capital firms are saying, one, for the people that we already invested into, we're not giving you more money. We need to see you make a profit. We need to see you turn around. And two, we're not investing our money into speculative assets anymore because we need a more solid, sustainable gain where we can rely on growth, because now we have a higher cost on our money. Because now when you're borrowing money at a higher interest rate, it's going to cost you more money to pay it back. So you need more sustainable returns. You need a more sustainable growth. And if the speculative companies can't show that they can do that, well, they're not going to get any more money. This is why we've seen so many tech companies see their valuations get slashed in half, sometimes 60%, sometimes 70%. Some of them are on the stock market. Some of them are private companies, where companies pretty much across the board have just been seeing this massive valuation crunch because companies, venture funds, hedge funds don't want to keep throwing their money into them the way that they were before. And so what do? Well, you have to increase profits. How do you increase profits? You got to increase revenue and or decrease costs. Well, increasing revenue is difficult when you were in a slowing economy. We are in a slowing economy right now. We've already seen 6 months of economic slowdown, or 2 quarters. And so what's the alternative? Cut costs. How do you cut costs? Let people go. And this is what's happening right now. We're seeing layoffs happen. Now, the job market is still very tight. Yeah, tech companies are doing layoffs. We are seeing job hires in other areas. But this is the beginning. And so where will it go next is what you want to pay attention to, because kind of like how inflation was just transitory in 2021, we're in a situation today where, hey, this economic slowdown might not be transitory like the Federal Reserve Bank and the government keep saying. It might be a real recession, although nobody wants to admit that, because if you say it's a recession, people get scared, they panic, they freak out, and then what do? They sell, causing asset prices to drop even more, and that's the worry that nobody in power wants to see happen. So they're trying to just make it seem okay. And this isn't the first time that we've seen this happen. This is why, one of the reasons why we created Market Briefs, which is our free financial newsletter where we break down what's happening in the top finance and business news into a fun, witty to read email that you can read in less than 5 minutes every morning. If you haven't joined Market Briefs yet, it's completely free. And I'll put the link for you down in the description below. But this is where understanding what's really happening is so important, because if we just look back a little bit, Ray Dalio says the history does not repeat itself, but it rhymes. Well, if we look back a little bit before the 2008 crash, in 2005, when the then chairman of the Federal Reserve Bank, Ben Bernanke, was questioned on what is going on in the housing market, is the housing bubble going to burst? His response, this is 2005, was there is no housing bubble to burst. Not that there is a potential housing bubble that will burst, but that there's no housing bubble at all. How could you even think that there's a housing bubble? That's 2005. Then by 2006, it started to become a little bit more obvious that we were in a housing bubble. By 2007, it became much more apparent that we were in a housing bubble, because now housing prices started to go down. People were getting worried. And I believe it was May 17th, 2007, I have the newspaper here somewhere, but Ben Bernanke came back out in a conference and said publicly that, yes, we have essentially a housing bubble that was led by subprime mortgages, which were very common before the 2008 crash. However, this subprime mortgage crisis is contained within the housing market and it will not trickle down to the rest of the economy. That was May 17th, 2007. About 1 year after that, that was when the whole thing burst. We started to see all of Wall Street essentially in crisis mode. We started to see bankruptcies. Lehman Brothers declared bankruptcy. We started to see a number of massive, too big to fail companies on the verge of default. And if you remember, just 3 years prior, there was no bubble, according to the Federal Reserve Bank. And this is where you want to make sure you can do your own research, because those 3 years between 2005 and 2008, it seems like a long time when you're in it, because when you think that you're in a bubble, you expect it to pop tomorrow and see asset prices crash tomorrow. Mm-hmm. That's not how it works. It's a slow process, and these things take time, and the media has a big influence on people's sentiment as to what's happening. But this is where you want to ignore the emotion and the hype in the media and be a little bit more educated and actually pay attention to what's happening, because there's a lot of things that happen behind the scenes, and many times they will try to make it seem like something else is happening. Like after the 2008 crash happened, after Ben Bernanke left office, he was questioned on what he said in 2007. And essentially the reporters or people who were questioning him were saying, how can you and the Federal Reserve Bank, who's made up of some of the smartest people, quote unquote, smartest people in the economic world, not foresee any sort of housing crisis? And what he said was, yeah, we did potentially see one, but we were told not to worry people about it. Because now, if he were to say, yeah, we are in a housing crisis, what's going to happen? Everybody's going to try to sell out of their homes as fast as possible before the bubble bursts. That would create panic and fear, and they did not want to do that. It doesn't look good for the world. It doesn't look good for politics. It doesn't look good for a lot of people, and so people didn't want to do that. And instead, what happened? The bubble got bigger, and even more people got hurt. So, I mean, it's the reality. It sounds silly, but this is what happened.
Doesn't seem much better.
And this is where, you know, the whole theory is always, this time is different. Well, is it? I mean, yeah, of course, it's different in the sense that our economy is not what we had in 2005. We don't have the same housing crisis issues. We don't have ninja loans. We don't have the same subprime lending. We don't have the same 0% down payment mortgages. We don't have the same adjustable rate mortgages going out right now. Although we do have a lot more adjustable rate mortgages happening today, it's not like 2008. But our economic issues are extremely different, because before 2008, we weren't worried about inflation. We weren't having some inflation crisis. We weren't having an economic slowdown because of inflation. The 2008 real estate crisis happened because the real estate house of cards trickled down into the rest of the economy. The concern today is this inflation house of cards is causing an economic slowdown, which could then trickle down into things like real estate, right? So it's different, but this is where everyone keeps saying, oh no, we're all good. The economy's strong. People have jobs. Inflation is coming down. Listen, 8.5% inflation, 8% inflation, even 6% inflation is extremely high. Yeah, 6% inflation, which we're not at yet, but 6% inflation would be considered much better than 9% inflation, which is where we were not that long ago. But this is where you have to understand that it's more than just starting to come down that you have to pay attention to, because inflation affects not just us here in the United States, it affects the world, because the world transacts and use dollars as their reserve currency. The United States dollar is the world's reserve currency. So now, if you are a massive country, let's just say Japan, China, Russia, I don't know, whoever, you're a big country, and you're holding onto dollars, like Japan and China hold on to a lot of dollars because, you know, it's like a quote unquote safe investment. If you are seeing 7, 8, 9%, even 6% inflation, that means the value of your investment is dropping pretty quick. That's not good news. You don't want to see your investment losing that much value that quickly. And so the concern is, what happens if other countries around the world start to think that way a couple of years down the line, and they say, you know what? We want a safer investment. We don't want the dollar. If that happens, then that creates a bigger problem, because then that could devalue our currency even more, causing more inflation. That would hurt our economy even more. And that would now create a lot of economic and political issues. And those are things that, I mean, yeah, this is, now we're getting into the worst case scenario type of situations. But the reality is countries do think like this. Like I talked about this in a recent video. I actually got demonetized because I talked about this. Really strange. But Business Insider reported how the BRICS nations, it was Brazil, Russia, India, China, and South Africa got together, and they are working to create a new reserve currency. Not the dollar, but their own reserve currency. It was led by, I believe, Russia and China, who got together saying that they wanted to move away from the dollar. Not surprising. Russia and the United States have some political tensions. China and the United States have some political tensions. So, I mean, that's not surprising, but then they got, some other big countries like India in there, Brazil. And one of the things that they were saying in that article was that essentially they want their new reserve currency to have some backing by physical metals, things like physical gold. This is one of the reasons that Russia might have been buying huge piles of gold, why China is also storing physical gold, because they understand that paper money, fiat currency, loses value. So they want to have something of real tangible value. So, these are things just to pay attention to. When I made that video, I don't know why YouTube flagged it as a conspiracy theory. I mean, it's an actual article on Business Insider. And then they demonetized that video. I don't know why. Maybe they'll demonetize this one too. but these are the things that you got to pay attention to that are just happening around you. And the goal of us talking about this is not for you to panic, okay? It's not for you to be worried, not for you to start freaking out, because that is absolutely not the intention. It does no good if you panic and worry. The reality is, look, these things happen. The United States is the strongest economy in the world. We have the strongest military presence in the world. We are the best place in the world to be. And these types of economic cycles happen. That's what I'm trying to get at. Economic cycles are a part of our economy. They are a part of pretty much every economy in the world. If not, no, it is every economy in the world that it is a part of. Like 2008 happened, 2001 happened. We had crashes in early 1990s. We had crashes in the 1980s and 1970s. And so you have to understand these things, they happen. Economic slowdowns happen. Recessions happen. Stock market crashes happen. Real estate crashes happen. They have happened and they will continue to happen. And for the majority of people, it catches them off guard. And then it creates fear, panic, anxiety. It causes people to sell at the bottom. It causes people to buy at the top, because now you get greedy, you get emotional. You hear about everybody making so much money in the market, so you want to come in and buy. And when you come in and buy like that, you come in and buy at the top, and then you see your market go down. You see your assets go down. You get scared, you panic, you sell. This is a very common trend. So who gets hurt the most? It's the majority of people who are not financially educated, who have no idea what's going on, who are chasing the quick buck. But that same environment can also create a bunch of millionaires, because recessions and market crashes create more millionaires than any other time. But it requires two things. It requires you to have the financial education, and it requires you to be prepared. The financial education means knowing what to buy, how to buy, and what do you do with your investments. Prepared meaning having access to capital, being prepared, having cash, saving money, putting cash aside, putting this capital aside when times are okay. That way, when times are bad, you have the resources to go and actually capitalize on the opportunities around you. It's like gravity. It makes people upset, but the reality is this is the system, okay? You can either fight the system or understand the system. You can cry about it or you can do something about it. You can complain about it or you can actually capitalize on it. This is where now the power is in your hands, because now you're getting educated and you understand, okay, maybe we will see further economic pain. If we do, will I be able to capitalize on it? Yes or no? In order for me to capitalize it, meaning yes, I need access to cash, my own cash, and I need the right financial education. That way I know what to do. If I don't want to capitalize on it, then who cares? Now, if everything is fine, inflation falls down, economy continues to grow, nothing bad happens, and you put money aside, oh no, you have a big bank account. I'm sorry that you have a big bank account. Go on a vacation to Disney World or go invest your money into something else. It's okay, right? So, I mean, the risk of you doing something, being prepared, is very low, because now, worst case scenario, you have a big bank account. The risk of you not doing something and not being prepared is so much higher, because now if things go bad, you lose your job, or things go bad and you don't have the ability now to take advantage of opportunities, now you're the one paying the price. So it's just like, if you look at that risk and reward, it makes so much more sense, where there's literally nothing to lose by preparing, not panicking, preparing, just having resources there. That way, if things go bad, you can capitalize on opportunities. And this is where people try to time the market, say, oh, it didn't happen today, it didn't happen next month. This is not one of those things that just happens like that. I mean, these cycles take time, and when everybody predicts it's going to happen, it's not going to happen. It's where when people are fully invested, when people don't have all these extra resources, when people don't expect it to happen, that's when it happens. Mm-hmm. And this is where, again, it needs that financial education. You need to be prepared. And the best indicator as to where it's going to go is the Federal Reserve Bank. Mm-hmm. Because if they continue to raise interest rates like they say they're going to do, because that's one of the ways they can fight inflation. If they continue to raise interest rates to fight inflation, that is going to slow down the economy, that is going to slow down asset prices, and that's going to push us into a deeper recession. I mean, it just is what it is, right? If you keep borrowing money, just think about it this way. If mortgage rates went up to 12% tomorrow, what's going to happen? No one's going to buy a home. Mm-hmm. Home prices are going to fall, because everyone's going to say, I can't afford this $500,000 home with a 12% mortgage rate. I was going to buy it with a 5% mortgage rate. This is the situation where they're going to keep raising interest rates. This is what they say today, that they're going to keep raising interest rates until inflation goes down. So the question is, what's going to break first? Is it going to be inflation or the economy? Is it going to be inflation or the housing market? Is it going to be inflation or the stock market? Because the faster you raise interest rates, well, yeah, you can bring inflation down, but the faster it's also going to hurt the economy and the stock market and the real estate market. And this is the game that the Federal Reserve Bank is playing. And inflation has come down slightly, but it's not low. Inflation is still very high. So there's a lot of room to go down here. And we're already seeing stock prices way off their highs. We're already seeing real estate prices way off their highs. We're already seeing the economy slow down. So the question is, what's going to give first?
I think the majority of people are angry at the economy nowadays. I saw a TikTok the other day of this guy talking about how he has, a job, but he also needs to have 6 side hustles in today's economy, because recessions just feel like they're so much more common nowadays. Like, just in my lifetime, this is about the 3rd or 4th time I think we've talked about a recession. Do you think that recessions are becoming more and more common?
I don't know about more common, but maybe a little bit more severe. Potentially, because we've always had recessions. Like, it's very common to see some sort of market correction or crash, whatever you want to call it, 8 to 12 years. That's kind of the general, like, okay, you're due for a market crash. And actually, prior to 2020, before the economy was forcibly shut down because of the pandemic, that was the longest period of economic growth and stock market growth in the history of America. So after the 2008 crash, before 2020, if 2020 didn't happen, it would, the economy would have boomed even longer. But that was the longest period of economic growth and stock market growth without a correction, without a recession in the modern history of America, like over a century now. So do I think that they're more common? No, but I think they are becoming a little bit more severe. Why are they becoming more severe? Because, well, we're printing a whole lot more money. We're putting a whole lot more money into it, which causes the bubble to rise even faster. Then when the money comes out, it causes it to fall even faster. It's like blowing up a big balloon. Yeah, you can blow it big, but when you pop it, it makes a louder noise. The bigger the balloon, the louder the noise. And that's kind of the situation here, where many times we try to ignore just the fundamental factors of what happens if we print $10 trillion and inject it into the economy. Are we not going to see inflation? You would think that we would know this, that it's going to cause inflation. Now we're in a weird situation where, oh no, we have too much inflation. We can't keep producing more inflation because now it's really hurting our economy. So it starts to create this dichotomy, because at first you're trying to just inflate away the national debt. But then that caused so much inflation that it's slowing the economy. And now when it's slowing the economy, that means that the government generates less tax dollars. Because remember, the government does not have an income. It is not producing a profit to generate revenue. They tax you, they tax me, they tax regular people, they tax businesses. So when you go to work and you earn money, when you have a business and you generate a profit, when you sell an investment for a profit, you're paying taxes. So when you earn money, you pay taxes to the government. And the bigger the economy, the stronger the economy, the more money people and businesses are making, so the more tax dollars that the government can get. Well, all this inflation that the government has been using to, help support the economy and grow the economy is now backfiring, is causing an economic slowdown. So what does that mean? We're causing the economy to slow down because of all the inflation. And now this economic slowdown is going to contribute to lower tax dollars. Because now if a business is making less profit, or people lose their jobs. If you lose your job, you don't have an income. If you don't have an income, you can't pay taxes because there's nothing for them to tax, right? The government taxes you when you earn money, when you spend money, when you buy something, or when you own something. So when you make money from a job, you pay taxes. When you go and buy something from the store, you pay taxes. When you own a home, you pay property taxes, right? So they pay taxes when you have to have money to pay taxes. And this is the situation where now they're facing the issue of the economy slowing down, which affects the taxes at a time where the national government debt is already breaking record highs every day. And this is part of the reason why the United States government has just passed the Inflation Reduction Act, which many of our viewers have coined the Inflation Production Act because it is a spending bill. It is $400 and some billion with the goal of trying to produce $700 some billion. But the concern is what happens if the costs of the bill are higher and they're not able to generate as much revenue from the bill as expected, because the bill is expecting best case scenario, the economy keeps growing and they can continue to generate these tax dollars. Where there's a chance that that might not happen. And this is the concern. And so this is where, just paying attention to what's happening, right? One of the provisions in the bill is the IRS is going to get an additional 87,000 agents and workers. Now, that's not people being hired today. These are 87,000 workers over the course of 10 years. Part of those 87,000 agents are to replace the 40 or 50,000 IRS workers and agents that are going to be retiring over the next 10 years. However, they're still stacking the workforce,
right,
to go after people who have not paid enough in taxes and who are not paying enough in taxes legally. So it's going to become exponentially more important for you to have a good tax advisor behind you, to make sure you're doing everything legally, to make sure that you're protected, because things are going to change. The government is going to need more taxes because they have all this national debt that they got to pay off. It's like you spent the last couple of years shopping at Gucci, Louis Vuitton because you had a big income, but now your company is getting hurt, so you just got a 50% pay cut. And now you got to pay back the Gucci, the Louis Vuitton, and the double guac. And this is what the government's trying to do right now, is they're trying to pay back their expenses, and they need more income to do that.
But the bottom line is be prepared.
Be prepared. How do you be prepared? Financially educated, and be prepared with cash.
That's good advice.
Well, Nate, appreciate the questions, the talk. If you want to see more of Nate, check him out on his channel. Join Market Briefs for free if you haven't already. The link is in the description, or you can go to marketbriefs.com. Thank you for watching, and as always, keep hustling. Food prices over the last 12 months have grown by almost 11%, 10.9%, which is the fastest rate that food prices have grown in the United States since 1979. And 1979 was a period when we were facing stagflation. So it was a very tough economy, meaning we were facing high inflation